Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go right to the man himself, Michael Halen. He's a senior restaurant analyst for Bloomberg Intelligence. He's been all over. Busy day today with the McDonald's news, with the Starbucks earnings. Hey, Mike, let's start with McDonald's here. Boy, if I were a long-term shareholder of McDonald's, I think I'd be buying stock here today because nothing's fundamentally changed other than this short-term, really unfortunate incident out in the West.
Yeah, I guess the question is going to be how short-term is it, right? Obviously, it was a tragedy. Somebody's passed away. You have 10 people in the hospital. That number could expand in the coming weeks. So yeah, I guess it's going to depend on when customers are going to feel comfortable going back to McDonald's. We think that some negative sentiment could linger. Obviously, this company has gotten ahead of itself in terms of pricing, and customers, especially low-income consumers, have pushed back by visiting less this year, and so. I think the timing of it was kind of bad. In terms of where the stock's at, I mean, the stock's been ripping higher over the last couple of months. It makes us think that they finally kind of hit on value and we're able to attract people back with this $5 meal in the last quarter, right? But with the stock near all-time highs, man, that's I guess that's a decision investors are going to have to make today.
So for the next earnings report out of McDonald's, do you expect any type of hit either to the sales or any earnings metrics that has to do with this E. coli outbreak news?
So this is going to impact the fourth quarter. So we think this is going to have a meaningful impact on the fourth quarter, and it'll probably bleed into early 2025 as well. We think traffic and same-store sales are going to get a hit because, I've been on TV 4 times already today. I'm sure all the major outlets are covering this story, and so it's going to turn a lot of people off from McDonald's, and I think there's going to be a lot of people out there that just may not feel safe eating in their local McDonald's. So I think it's going to impact sales and traffic and earnings for at least a few quarters.
And Mike, aren't the vast majority of McDonald's, aren't they franchised versus company owned?
Yes, yeah, they're 96% franchised. So yeah, the largest impact is going to be to the franchisees. That's a great point, Paul. Franchisees are going to suffer the most, because McDonald's is so heavily franchised. They'll take a top line impact, but there's less operating leverage in that model, right? And so because of that, their earnings aren't going to get hurt. The last big example of this was Chipotle. Chipotle owned all their stores.
Yeah.
And so when their same-store sales dropped 20% in 2017, their margins got decimated, right? Because there's just a lot more operating leverage in the model. So, for that reason, there's a lot less risk to the McDonald's story in this case versus what we saw with Chipotle back then.
So, Michael, Paul said that he's been ordering the same thing from McDonald's since high school. I imagine that when he first
and that's going back.
Ordered it, maybe the burger was $2, $3.50. I want to talk about pricing, though. How is McDonald's doing right now with being able to raise prices with a consumer that is kind of constrained by higher interest rates and inflation right now?
Yeah, it's not just them, it's all of the restaurant industry, but especially quick service. 30% of their transactions are made by low-income consumers, and there's this K-shaped economy, right, where if you own assets, right, if you have a lot of money in your 401k and you own a house and, you're doing pretty good, right? But inflation has squeezed the hell out of low-income consumers now for 4 years, and they're just shopping at the grocery store more often. They're cutting back on their visits. They're cutting back on their checks when they do go to the restaurants, right? And so McDonald's franchisees, because they're the ones that set the pricing, and everyone else in the restaurant industry is struggling mightily to raise prices on their consumers this year. And and the rising, ever since the 50 basis points cut, commodity prices have just gone up since September when we started pricing that in, right? And so that's a big concern for restaurateurs, I think, in 2025. All
right, Mike, let's switch gears. Look at Starbucks. SBUX is the ticker. to put into your Bloomberg terminal. Stock's off about 0.5% today. It's pretty much unchanged on the year, so badly trailing the S&P 500, which is up about 22% here. What's going on at Starbucks here, Michael?
Yeah, they played catch up a bit once the appointment of Brian Niccol the hiring of Brian Niccol was announced. Brian Niccol started last month, and he's moving quickly, man. He's making a lot of management changes, and he's aggressively making moves to simplify operations. They're going to rationalize menu items, make it easier to execute. And try to bring hospitality back to the coffee shops, right? They want to free up their employees, their partners, as they like to call them, to get back to knowing the names of their customers, right? And being able to greet them with a smile and friendly service, right? And so that's going to be job one. And then from there, they're going to expand on the marketing side. Starbucks has historically only marketed to its rewards members, right? And Brian Niccol wants to expand that to everyone. Right, and we think that's a smart plan. We think they've been underinvesting in marketing for a long time, and we expect it to pay dividends as early as fiscal 2025.
What has the company said to explain the 7% decline in same-store sales? Because before you came on, we were talking about how you have to wait in a really long line to get your Starbucks. There's less foot traffic.
If you're doing the drive-through, right? Yeah,
if you're doing
exactly.
There's, I guess, maybe some teens in the store, but there's less people in the store. What have they said about really what's driving that decline?
Part of what new CEO Brian Niccol has said is like it's largely about the experience. It's become largely transactional, right? They've lost that customer service feel. They've had the trouble executing the orders. A big part of it is and then he also mentioned that, all of these new menu items that they added to try to bring people in didn't work, right? And then, to your point, pricing has gotten ahead of itself at Starbucks as well. And then China, there's a huge price gap between the prices that they're charging. Sometimes they're charging 3 times as much as some of their smaller competitors like Luckin Coffee and K Coffee. So, price has also been a big part of their issue, and it's something that they're going to address right away. I've
seen some crazy graphics in various articles showing the permutations of the different orders that one could have, and if you're a barista, it's virtually impossible to learn all these. Is there a sense that they got to simplify just the menu a little bit?
Yeah, that was they issued a video yesterday after the close, and that was a big point of emphasis. It was like making the jobs of their baristas a lot easier and their employees a lot easier, right? And so, when an employee is stressed, it's very hard for them to provide the customer with a good experience, right? So this all flows downhill. So making the baristas' jobs easier, making it a more enjoyable environment for them is going to flow down to the consumer, and then it's going to result in better traffic and same-store sales.
We don't have a ton of time left, but I was curious to get your thoughts. Brian Niccol said, the company said that they're pulling back this guidance because the CEO needs more time to kind of think through all this. How unprecedented is that? Just 30 seconds.
No, this is very common. Any good CEO worth his salt is gonna suspend guidance so they have more time to get their initiatives in place. This is a huge company. It's going to take a long time for momentum to start building in the right direction, and this is a wise move.
All right, Michael Halen, busy analyst today here with Starbucks and McDonald's in the news. Michael Halen, senior restaurant and food service analyst for Bloomberg Intelligence, joining us from the BI office in Princeton, New Jersey.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Emily Graffeo sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio, and we're streaming live on YouTube as well. Boeing back in the news again today with some earnings. Not a good cash flow story. Stock's down 3.25%. Boeing CEO Kelly Ortberg provided an unvarnished view of his company at a crossroads, absorbed by challenges ranging from huge debt to serious performance lapses that it needs to address before it can consider developing a new aircraft. To break it down for us, George Ferguson joins us, Senior Aerospace, Airlines, and Defense Analyst for Bloomberg Intelligence. So what did you see in this earnings release, George? What did you hear from new CEO Coli Outbreak as you think about this Boeing story right now?
Yeah, so I think you touched on the most important thing that we heard on the call, and I think it was that cash burn continues into 2025. Worse in the front half of the year. Something like in the back half of the year, cash, there can be some generation, but it'll finish the year negative, which really leads me to believe, right, they just got to raise cash here shortly because they don't want to dip underneath that $10 billion amount they need to run the company. I think also I found it interesting, away from his discussions on the culture of Boeing and how it needs to change. I think everybody understands that. We all agree. I found it interesting too. A couple analysts went at him about selling divisions. Didn't get a lot out of him, I think, on selling parts of Boeing to raise money. Look, I know he's busy. He's been first couple days, but my guess is they've looked at ways to raise cash, and we didn't think there was much potential to sell big chunks and raise cash, and it didn't sound like Coli had any of those on top of his list either. So I thought it was the most interesting stuff.
What did the CEO say about the serious performance lapses that Boeing has had over the last year?
Yeah, I mean, what I heard was, the serious lapses. I guess he kind of owned up to them as well. But again, I think we all knew that, and that he thought companies still had potential for a very bright future. They're part of a duopoly, large backlog, and I think he understands that they need to bring back the machinists as soon as they can, in a way where they're happy and ready to build product well, and that's the path to success. And so, but again, I think he kind of owned again the problems of the company. But we've heard this before, right? I think now the question is, how do you change it? How do you turn it around? All
right, the most immediate, milepost for this company is settling this strike, and today is the day. The rank and file out there in the Pacific Northwest are going to vote today. Any consensus how this might go?
I'm not seeing any. I mean, I'm in the camp that it looks like he has a pretty good shot of it, because again, I think I've talked before that the union's been out now for about a month. So I'm sure they're starting to feel the pain of not having a paycheck, or at least a paycheck as large as they're used to coming in. They're pretty close to the terms that I think they're all looking for. I think the union might have been looking for 40%. I think they'll get, 35 sounds pretty darn close. I don't know if you really want to hold out for the extra 5%. And they sweetened up some of the 401k matching and some bonuses. So to me, it feels like they're pretty darn close. And given the timeline since they last all worked, it kind of feels like he might get it tonight.
All right, so the long-term challenge, I think, for this company, and I just happen to know a couple of, long time, really right out of college engineers at Boeing, and it goes to that culture issue of, the engineering first, maybe not necessarily profitability metrics first, but engineering first. That there's a belief, in, at least by some, that the company needs to get back there. A, does a company believe that? And B, is there any sense that they can actually do it?
Yeah, I mean, I do think they can. I think, it's going to take a wholesale, change in attitude here. I do know people as well inside Boeing, and I hear a lot of stories about, non-engineers running around with clipboards trying to figure out how to manage programs that are very technical, in very technical programs. And so I think it will be hard to change it. I think they can't lose sight of profitability. And I think even Coli, as he tells you, we got to get back to engineering and a manufacturing culture, he's canceling the 767 because he thinks the prospects for the future aren't as good, right? He said, look, this program was coming to an end anyways. Let's just get distractions away from us. So they can't lose sight of profitability, but they have to get back to engineering prowess and manufacturing skills.
The stock is down almost 40%, or over 40%
this
year to date.
Yep.
Is there a sense in the investor community that this is we're near the bottom for Boeing?
So look, the other day, I think Monday, when you saw the announcement of, the next proposal for the union and a vote coming, you saw the stock move. And so I think that alone is an indicator that, look, on Wall Street and financial markets, hope is eternal. And there are some folks out there that think they see value in this.
When do you, if they do come to market with either debt or equity capital, George, when do you think that'll be? Now that they've got the earnings behind them, seemingly they have the green light.
I think that they want to see the vote tonight, right?
Okay.
And so my sense is it's coming late this week, next week. I think they want to see the vote tonight and figure out what they think they need, right? If Kelly doesn't get the vote, if the vote doesn't go his way, it's going to be a larger chunk coming out of the.
I see what you're saying. Yep, that makes sense.
Yeah.
All right, George, thanks so much once again for giving us a few minutes of your time. George Ferguson, he's a senior aerospace, defense, and airlines analyst for Bloomberg Intelligence. He's been our go-to voice here on really the last several years on Boeing when they've had these, really serious safety issues, doors, flying off airplanes and things like that, cracks in the wings. And so they really need to, obviously, as they've been saying for a long time, get that focus back on quality, but now they've got the, the shorter term issue of managing this strike here, which again is, into its fifth week right now. So they will have a critical vote, the machinists tonight. Will they support what their union leadership has agreed to with the company and end their strike? So again, a key vote today for the striking workers and for the company and for the industry. And you think about all the supply chains that fall back from Boeing, all the suppliers that supply Boeing, they're pretty much on standby waiting for this thing. So it just affects a lot more people and a lot more companies than just Boeing. So keep an eye on that. That'll be breaking news tonight in Bloomberg. We'll certainly cover that as well.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk about the markets here. Carol Pepper joins us, founder and CEO of Pepper International. Carol, a lot of folks have been climbing this wall of worry about the stocks, but we got the S&P up 22% this year. What are you telling people who are concerned that are saying, oh boy, this market's too far over its skis? What do you tell them?
I tell them, relax. First of all, it's not too far over its skis. There's a lot of good news in the market. And really, as you guys know, I manage money for people with over $100 million. And we're starting to plan what should we be doing post-election, post the next rate cut, because that's really where you want to look. Just like Wayne Gretzky said, don't skate to where the puck is, skate to where it's going to be. So we need to stop being focused on the election and terrified. Whoever wins, it will be a fair and free election. There will not be another January 6th, I don't believe. So that means we really should be focusing on what is January 25 going to look like and what's going to happen after the next rate cut. And that's all good news. The market is pricing in the fact that we will have lower rates. The election will be finally out of the way, so whoever's in will know how to position ourselves, and there will be a relief rally. So you want to be looking during these fearful days, these worry days, what can I buy that I don't have that will do well in the good times? Because believe me, the good times are coming. No matter who wins, I think we'll have a really strong first quarter next year. And so let's position for that, which to me means growth. Let's look at growth again, because during fear days, growth is what goes down. You see the NASDAQ drifting lower when people get scared, and then when people are excited, the NASDAQ shoots up. So when it's down, this is the time to look at your portfolio and say, what am I underinvested in? How do I get into the strong names that will do well when we're past the election?
So what does growth mean to you? Is that Mag 7, or is that taking on a new, definition? Do you prescribe a new definition of growth? No, I think it's Mag 7. I think it's NVIDIA. I think it's things that are going to be working as we go into the future. So that means artificial intelligence, big tech. The big leaders are going to stay strong and get stronger. Names like Starbucks will come back. McDonald's will recover from this blip of, bad onions. And so I always say, bet on the big growth names, because that's really where you're going to see the turbocharging when things are going well. And don't forget, these big AI companies need to have a lot of data centers. That's more manufacturing jobs. They need lower interest rates. Those are coming. So that is only, even though NVIDIA looks like a crazy name with over 500% return in 3 years,
it's just getting started. Look at the long-term returns of Microsoft and Amazon and some of the big names, how they've done over 20 years. And you'll be very glad if you put some of these new big names in your portfolio and just close your eyes. Put them in on a fair day and leave them there and say, you know what, 10 years from now, I'll thank myself that I did that.
So you have been consistent on your NVIDIA call there for sure. Now you're talking to us a little bit about energy names. And I've looked at, we've seen WTI crude oil just over the last several weeks really be volatile with some of the escalation and tensions in the Middle East. What's your energy call here?
Yeah, I really think that energy is going to stay below 100, but stay above 50. I really think we're going to be in that band for quite a long time. And, I'm a great believer in renewable energy. I'm a great believer in the new carbon markets that are going to get started. That will be a whole new asset class that we can talk about next year and in 26, where we are offsetting the emissions from these fossil fuels. But I do not believe fossil fuels are going away in any way, shape, or form. It's just a question of how will all the various components of an energy market fit together. And for that reason, I think energy should be a core part of your portfolio. It will go up, it will go down, but it's going to stay in a band, certainly for the next 10 years. And it's a great dividend payer generally. So again, stick with the big names, stick with the Exxons and groups that are going to do well. And frankly, a lot of those companies are very committed to renewable energies, fossil fuels, offsetting their carbon footprint. They really have massive departments now who are doing that. That is not a conspiracy theory. That is a fact. And so for this reason, I think even for any ethical investors, it's an important part of your portfolio.
Carol, how dependent is your bull thesis that you've laid out here on, more rate cuts from the Fed? Because we've seen traders kind of pare back the level of, or I guess the number of rate cuts that we're going to see this year, potentially next year. How many rate cuts does your bull thesis need?
I don't think the number's actually important. I think it's the trend and the trajectory. So is it 4 cuts over the next year or two? Is it 3 cuts? It will be fewer cuts if the market is strong. It will be more cuts if the market is weak. And where those numbers will turn out are up to the Fed, frankly, nothing that we can really project. But I don't see a situation where they're going to start raising interest rates, certainly, because I think they did a great job of getting us the soft landing that we needed. I think we're getting that soft landing. And again, technology, we can't discount what technology is doing in terms of increasing productivity without increasing costs, but at the same time, frankly, allowing for higher wages for the workers. I mean, that's a nice sweet spot to be in, where you can raise your wages and have more productivity at the same time. And I think we're going to see that trend continuing.
Right.
So I'm not really dependent on a particular number of rate cuts, because of course, if the Fed announced fewer rate cuts in the beginning, the market will go down and be upset for a week or two. But the second there are good earnings coming out and
Right.
they see that the corporations are still strong, the market will come back.
Hey, Carol, thanks so much for joining us. Always appreciate getting a few minutes of your time. Carol Pepper, founder and CEO of Pepper International.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Got Emily Graffeo sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio and are streaming live on YouTube as well, so check us out there. We had a deal in the data security business a couple of days ago. Sophos, I think Thoma Bravo owns Sophos, acquiring Secureworks in an all-cash deal. Values the company, Secureworks, about $859 million. Secureworks is a publicly traded company. SCWX is the symbol. We have Wendy Thomas. She is the CEO of Secureworks. Wendy, talk to us about this transaction. Why sell? Why sell to Sophos, and what's the pro forma company look like?
Yes, good morning, Paul. This is a strategic combination of 2 longtime security market leaders. And so when you think about combining our 2 agnostic, very open platforms, decades of cybersecurity experience and strong brands in the space, this is a way to really scale up and defeat the adversary at scale.
What does it say about the current market for cybersecurity companies that this acquisition is going through?
The market is really looking for a single partner for cybersecurity, sort of a consolidated platform play that one organization can increasingly address multiple use cases for their security needs, from being proactive about vulnerability management to reactive to detection and response capabilities, all the way to AI-powered platforms that can predict the next cyber attack. And so the scale of R&D required to make that a reality for customers is one that requires scale in organizations. So to take two cash flow positive, growing leaders in the space and put them together means more scaled R&D to be better, faster, stronger for customers.
All right. So what are your customers doing with cybersecurity these days in terms of their spending, their investment?
They are increasingly moving from what I would call preventative cybersecurity investments to proactive cybersecurity posture and risk management. This is all about moving towards increasing prevention. And the reason is that dwell times of threat actors in an organization's environment have gone from months to days to now hours. So with the power of an AI-powered platform, in order to really be able to keep constant visibility about potential holes in their attack surface, right? Those unlocked doors, as I like to talk about. It requires technology to do that, technology to detect that someone's rattling that door handle, and the ability to immediately protect the organization from someone getting in and taking those valuable data assets or encrypting their systems with ransomware.
So you're using an you're an AI-powered security platform. I'm wondering how difficult it is right now to be a company that's using AI when it seems like demand is outpacing supply. Is that a challenge for you guys?
Well, if you think about AI, that's a pretty broad category. And while, natural language processing and generative AI is the hot topic right now, and it has its place in security in terms of things like changing cybersecurity detections into readable language of what's going on to a business person. We've been using AI for a very long time in our platform when we started building it in 2017 for things like machine learning, deep learning, statistical learning, in order to sort through tremendous amounts of data and find patterns of behavior that we can match to threat actors, the way that they try to come into an environment, the software that they use in those tactics and techniques. And a platform like that can filter through a lot of data and find those patterns is the key to being able to protect an organization. So it's home built for both Sophos and for Secureworks, their hub platform and our Taegis platform. It just makes a ton of sense to be able to take the best of both worlds and put those together.
All right. So you and I, Wendy, we first chatted back in 2021. How has your company, how has the industry changed over the last several years?
The industry is, I think, on a path for the first time in a long time to really consolidate. And that is, frankly, as a result of customer demand to be able to run a holistic security program, understand, frankly, quantify their risk, demonstrate where they've protected against that risk, and then have the accountability around who is attacking their environment and how they've protected against it for their boards and C-suite. It's become a boardroom topic for the last couple of years. And so the ability of a security professional to elevate sort of a technical pursuit into the language of business and risk is probably the biggest change that I've seen over the last few years.
I want to zoom out and just talk about the cyber industry more broadly and how different corporations should be thinking about the current state of threat to their businesses when it comes to cybersecurity. Are we worse off than we were maybe 5 years ago as hackers get more advanced?
I would say that the great things about AI that have enabled us as businesses or security companies to leverage the power of that AI has also represented a certain amount of peril in terms of empowering those threat actors as well. And whether it's nation states or cyber criminals who are involved, their ability to use the same sort of natural language processing technologies to make that phishing email much more believable. It really does look like it's coming from your bank or from a vendor that you use. And so the last line of defense always beyond technology is people. And the need for all of us to become more educated and just cyber aware is more important than ever. So there's always that human edge that can make the difference on top of technology to keep us all a little bit safer. When cyber criminals cannot make money off of global citizens, then we start to break that economic model.
All right, Wendy, thank you so much for joining us. Wendy Thomas, she's the CEO of Secureworks. That's a publicly traded company. SCWX just recently, in the last couple of days, agreed to be acquired by private company Sophos in a deal for $8.50 per share in cash, which was a pretty solid premium to the pre-deal talk there. And Sophos is owned by the private equity firm Thoma Bravo. So more consolidation in the data security business. It seems like an area that is just going to get significant investment for as far as the eye can see, because I mean you have to continue to, I think, invest in cybersecurity, because as you mentioned, Emily, the state actors, the private actors are just getting smarter and smarter and more aggressive.
Exactly. You'd imagine the threat just gets worse.
Yep.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, let's get a sense of what's happening with these markets. John just reporting we have a sell-off in place here today, but otherwise we are at or near all-time highs for these markets. We're right smack in the middle of earnings, so it looks like people feel pretty decent about the earnings that are coming about. Let's check in with somebody who does this stuff for a living. Loreen Gilbert, CEO of WealthWise Financial, joins us via Zoom from Dallas, Texas. Loreen, thanks so much for joining us here. What are the discussions you're having with your clients these days, as they had a pretty good 2024 year to date, both in stocks and even bonds are giving you some pretty solid returns? What's the conversation like these days?
Well, it has been a really good year, and what's on everybody's mind is the upcoming election. And it's interesting to see how many people are holding this wait and see mentality on what to do with big life decisions, whether it's buying a house or making a move with a business. A lot of people are just playing wait and see. So the talk has been, how will this election affect my portfolio? And to that question, we say there shouldn't be a lot of allocation changes based on the general election, because we already know that this year is a positive year for the market. So we don't expect that to change. It's been a fantastic year across the board. And so the real question is, what happens next year? And to that, we look to Congress. So more important for the markets would be what kind of legislation could be enacted in Congress. So who controls Congress could have an outcome as to what happens on corporate tax rates, on individual tax rates, on regulations. So all those things are of concern to people.
When you think about where we are right now in the business and economic cycle and markets, is there still room for this bull market to run? We just had 6 straight weeks of S&P 500 gains. That was the best winning streak for the index all year. Where are we? Are we still early? Are we mid-cycle? What do you think?
Well, we're in a late cycle, there's no doubt, but this rally now is 2 years really in the making. And the odds would say, or the history tells us in the markets, that there is still room for this market to run. So we're of the opinion that the market continues to run, that we'll see. Right now we're seeing a pause in the market. A lot of that is profit taking from stocks. So even, looking this morning at Nextera that reported and beat on earnings, missed a little bit on revenue, but at the end of the day is still flat on the price. And so there's been definite profit taking. Coca-Cola is another example of reporting and then the stock going down. So I think what we're seeing is some profit taking before year end, a pause. And yet I will say, we think there is definitely room to run. And the fourth quarter expectations for earnings are very robust. So while third quarter is somewhat muted on year-over-year earnings. Fourth quarter, we're expecting quite a bit.
Loreen, I kind of grew up in the age of the 60-40 portfolio, but I know that's kind of a thing of the past. That, in fact, a lot of not just institutional investors, but retail investors like to have some alternatives in their portfolio, whether that's hedge funds, private equity, private credit. How does that conversation go with you and your clients?
Alternatives definitely have a place and a space, and it all depends on the liquidity of the client and their risk tolerance, definitely. Equities, public equities, there's nothing that can replace that because of liquidity and long-term growth as well as dividend income. So your equities have a place right now. We were talking about bonds have done very well, and the expectation is over the next 5 years, we see the bond market being very robust as rates come down, and that trend will be our friend, so that we'll see long-term, what I mean is 3 years to 5 years, some robust returns on fixed income. So we can't negate that or neglect it. And so then you are left with alternatives as well. And what alternatives can do is diversify a portfolio. There are liquid alternatives and there are non-liquid alternatives. So making sure you're using probably a combination of both of those, whether it's hedging a portfolio, looking to commodities are considered in a sense an alternative, looking at private equity as a long-term hold. So there's lots of different avenues and ways to play it. Looking at macro elements too. So lots of ways to play alternatives, and we believe in that. We've got a double-digit allocation in alternatives in our portfolio.
I know you had mentioned that the election not really kind of a longer term concern for investors, especially those who have maybe a longer time horizon than traders. So when you do think about maybe the next year ahead, what are the risks to the market and your outlook?
Yeah, so it really is, there is a risk. The risk is we go into a recession. And looking at history, during a rate cut cycle, most of the time that's very positive for equity markets. And the reason it's positive is if you can go into a rate cut cycle and avoid a recession, then the markets do quite well and have double-digit returns. If the rate cut, then we go into a recession, then we're going to see negatives on stock market prices, no doubt. Now, we believe that we're going to still see continued growth in the economy. We don't see this economy, even though the leading economic indicators we're seeing going down, we don't think that that means we're heading right now into a recession. So if we can avoid a recession, we see the stock market doing quite well in 2025. So right now, our base case is that there's not a recession, that the Federal Reserve continues to lower rates, and that the market will continue to rally.
All right, Loreen, thank you so much for joining us. Loreen Gilbert, she's the CEO of WealthWise Financial, joining us from Dallas, Texas via that Zoom thing.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Sometimes a headline gets your attention. Boy, this one does. Cracked skull, fractured bones show danger at Rivian's factory. That draws you right in. So I want to get right to the reporter on this story. It's a big take story. We love the big take stories. Really cool stories. Deeply, deeply reported, resourced, and sourced, and great graphics, all that kind of good stuff. So make sure good long-form journalism. Kiel Porter joins us, Industrials Reporter for Bloomberg News. Kiel, talk to us about Rivian. I remember talking to Bloomberg Intelligence analysts years ago, and they say, hey, the technology of EVs, that's one thing. But at some point, they got to go start bending some metal. That's another whole thing, entirely. And these companies don't have any experience in it. What did you find at Rivian?
They're really struggling to build a safety culture that they can be proud of, in short. There's been numerous incidents, some of which you spelled out in the headline, others which we didn't put into the story, others which haven't been investigated by OSHA. If you talk to people out there in Normal, Illinois, a lot of them go to work every day because it's the best paid employer in the region, but they don't feel safe.
So, they only have one plant here. I'm wondering, how did Rivian like if I were starting up a new auto company, I'd just go over to Ford or GM or Stellantis, steal a bunch of their factory people and say, hey, guys, start building my car here. How did Rivian do it? How is Rivian kind of, I guess, learning on the job, if you will?
Well, Rivian got a deal. The plant that they have, they purchased for $16 million. It had been abandoned by Mitsubishi when they were trying to make an electric car in the US. So it's sort of all fell into place. There were still workers from the time that it was owned by Mitsubishi that could come in and work. So they felt that they could get some muscle memory. And then at the start, it was designed to be a very niche car maker. And then they got the Amazon deal, things exploded, and they had to ramp up.
So what's the company responding? Like, how they kind of respond to this? Or do they have any policies in place to try to address this? Because I'm just looking at another great graph you have in the story that just shows the number of serious violations cited, and Rivian's at the top of that list.
Yes, it is. And as you pointed out, it's only one factory with 8,000 staff. Most of the companies on that list have multiple sites and tens of thousands of workers. Company... Oh, sorry, continue.
No, good. So I just want to know kind of how the company's responding here.
They responded in great detail to us. I think it's fair to say. They pointed out that most of the serious citations that they were issued were ultimately downgraded or in a couple of cases dismissed, which is true of most people that go through the citation process. And they pointed us to things that they've done to improve their safety processes. And indeed, OSHA itself has commended the company for being open and looking to improve its health and safety.
So is Rivian any materially different than, say, a Tesla factory or, the other EV makers?
Well, it currently only builds two types of vehicle. You have the Amazon truck, and then you have the R1, which comes in two separate models. It's an SUV and a truck. And they're looking to ramp that up with an expansion with the R2 next year. So it's smaller. I think it's aiming to produce, now they actually cut their forecast for this year, about 50,000 vehicles. So the scale of it is much smaller.
Does Rivian have the money to invest in their plants into the safety? Because, boy, you look at the stocks of some of these companies, they're just so volatile. And I wonder if they even really have the money to invest in safety protocols.
It's a question to ask the company, that they say that they have a real commitment to safety and they are investing in it.
Is making an EV, I don't know, it seems like they're not building an internal combustion engine. So they're not actually building an engine. I would think the process is a lot different. Is it any more or less dangerous, as the industry said, versus, say, a traditional gas assembly plant?
Given that you're building this thing from scratch, from the engine upwards, there's a lot of process that has to be learned. There's a lot of things that need to be learned. Indeed, one of the things that the company was cited for was a movement vehicle that the engineers had designed and, wasn't safe for employees to use. They were telling employees to be careful until OSHA cited them and they figured out a way to do it differently. And you could replicate that across 1,000 examples, from how you attach the doors to how you put the glass in. You could go on and on and on. And Rivian's had to work out new and different ways of doing all these things for these new bespoke vehicles.
But the employees, I guess are they aware of the hazards when they take these jobs?
That's a very good question. It's rapidly becoming a company town. Most of the people that we spoke to for the story are one of several family members who work at the plant. They all talk about how when the plant first opened, it was very small, very welcoming. You saw members of senior management. It felt like a family. And as production has ramped up, that's gone away. And there's been a pressure just to produce.
Interesting. All right. Interesting story, Kyle. Appreciate it. Kiel Porter, Industrials Reporter for Bloomberg News. He's got the big take story about Rivian and working in their plant in Normal, Ohio. Some of the safety concerns there. You can read more of this story on the Bloomberg and at Bloomberg.com/big take. Looking at the stock of Rivian, it's down about 2% today. It's down 56% year to date. It's got a market cap of $10.3 billion. So again, reflecting some of the challenges of starting up some of these EV companies and the volatility around kind of the adoption of electric vehicles, which is really still, I think, pretty uncertain as to where the ultimate demand is for electric vehicles. We're seeing that in some, different demand numbers we see out of some of these companies.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.